Hi, my name is Hada Syamimi binti Hanis and my metric number is 288715. And today our group will be presenting the evaluation of the public listed company performance, which are the Mr. DIY company. So now I'll be starting the presentation by analyzing the liquidity of Mr. DIY using key financial ratios. First, let's discuss the current ratio. One common metric for evaluating liquidity is the current ratio. This ratio measures a company's ability to meet its short-term financial obligation by comparing current assets to current liability. A balanced current ratio indicates sustainable funding, debt, and asset management. In 2022, Mr. DIY current ratio was 1.09. This shows a solid financial position with sufficient current assets to cover short-term debts. By 2023, the current ratio improved significantly to 1.63. It reflects a dramatic increase in cash reserve compared to the previous years. We can see that Mr. DIY company's current ratio surged from 1.09 in 2022 to 1.63 in 2023, indicating a significant improvement in liquidity or cash reserves. We suggest that the company needs to sustain and maintain this progress, so Mr. DIY should continue to manage its current assets and liabilities effectively. This involves ensuring a balance between cash reserves, account receivable, and short-term obligations. Next, we have the quick ratio. It is like the current ratio, but it only looks at the current asset that can be quickly turned into cash. The quick ratio, also known as the acid test ratio, compares a company's short-term ability to pay its debt. In 2023, the company quick ratio was 1.63, which means that it had a better ability to handle its short-term debts with liquid asset compared to the quick ratio of 1.09 in 2022. Mr. DIY quick ratio improvement suggests effective management of liquid asset and current liabilities. So we suggest that to further enhance the quick ratio in 2024, Mr. DIY should concentrate on increasing its liquid assets while managing the current liabilities effectively. This can be done by improving the efficiency of account receivable collection through stricter credit policies and enhanced collection efforts. Finally, let's discuss the cash ratio. This ratio measures a company liquidity by comparing its cash and cash equivalents to the current liabilities. It is especially useful if an analyst finds that the company's inventories or account receivable are low quality or pledged for short-term credit. In 2022, the cash ratio was 3.60, indicating RM's 3 ringgit and 60 cents in cash for every 1 ringgit in the current liabilities. By 2023, this ratio dramatically increased to 7.25, reflecting that RM 7 ringgit and 25 cents in cash for every 1 ringgit in the liabilities. This significant rise indicates a substantial improvement in the company liquidity from 2022 to 2023. So here we know that the high cash ratio also indicates that Mr. DIY have a substantial amount of cash available to cover their short-term obligation. So we suggest that to sustain and further improve this ratio in 2024, Mr. DIY should focus on efficient cash management practices. This includes maintaining robust cash flow by optimizing cash inflows and outflows, improving their account receivable collection, negotiating extended payment terms with suppliers, and also investing in short-term and highly liquid assets. So that will be all for the liquidity ratio of Mr. DIY. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Batrisyia and my metric number is 288229. Now I will continue with my presentation. For my part is profitability ratio. For the first one is a profit margin. In 2022, the profit margin for the DIY company is 1.007 and it increased to 1.010 in 2023. It indicates an improvement in the company's profitability. Despite its apparent smallness, this 0.298% growth shows that the company's ability to turn a profit in relation to its revenue is on the rise. This suggests a better cost management, operational efficiencies, and potentially higher revenue relative to expenses. the solutions to enhance performance further, DIY companies should focus on digital transformation to streamline operations and reduce costs, use advanced data analytics to optimize supply and management, and lastly, to improve the customer experience for higher revenue. For the second one, the return on asset in 2022, the return of asset for a company is 54.07% and it increased to 64.15% in 2023. The increase in ROE indicates that the DIY company's financial health and operational efficiency have improved from 2022 to 2023. This positive trend reflects the company's enhanced ability to utilize its assets to generate profit, suggesting a favorable performance and a potential for continued success. The solution to sustain this positive trend, the DIY company should continue investing in asset optimization, adopting advanced technologies, and improving operational processes, expanding market opportunities, and maintaining strict cost and control measures will further enhance profitability and support ongoing success. So, for the third one, it's the return on equity. In 2022, the return on equity for the DIY company is 33.01% and it decreased to 32.12% in 2023. While the DIY company experienced a slight decrease, it still maintains a high level of profitability. The minor decline indicates a slight reduction in efficiency in generating profits from shareholders' equity. Despite this, the company continued to perform strongly with an ROE above 30%, which remain indicator of good financial health and effective management. The solution for this problem is the DIY company should focus on enhancing operational efficiency and cost management to maximize profitability. The company can invest in innovative technology and process improvement to boost productivity and reduce waste. Other than that, enhancing shareholder value through strategic reinvestment in high growth opportunities and optimizing the capital structure by managing debt level effectively can further strengthen ROE. That's all from me, and I will pass to the next presenter. Thank you.
Hi, my name is Nur Izaatul Husna binti Zakaria. My number matric 288708, and I will continue the presentation with solvency ratio, which is debt to equity ratio. If you can see in this slide, the DIY company debt to equity ratio dropped from 3.962% in 2022 to 3.324% in 2023, and a lower debt to equity ratio means a larger equity base and less dependence on debt, and suggesting greater financial stability and decreased risk. This indicates effective debt management and the potential for self-funding operational and expansion without excessive borrowing. And for the solution to sustain this trend, the company should continue managing debt effectively and need to prioritize equity financing. Additionally, implementing strict cost management and maximize revenue can further reduce dependency on debt. Debt ratio. The Mr. DIY total debt ratio is dropped from 2.791 in 2022 to 1.988 in 2023. It showed a decrease in a total debt ratio compared to in 2022. This indicates that the company has reduced the debt financing and show a positive result in their company financial performance. And the Mr. DIY company has been improved their financial health. For the solution, this reduction in debt financing reflects the positive on the company performance. To sustain that and enhance financial health, DIY companies should continue controlling debt level while focusing on revenue generation and cost management. Next is equity multiplier. Mr. DIY company equity multiplier ratio is decreased from 1.003 in 2022 to 1.002 in 2023, indicating an improvement in its capital structure and financial performance. A lower equity multiplier suggests reduced financial leverage, indicating that the company relies less on debt financing and more on equity fund its assets. And for the solution, this reduction suggests increased reliance on debt financing relative to equity, and potentially indicating a more conservative approach to financial leverage, maintaining a balanced mix of debt and equity financing, along with efficient capital allocation strategy, can further strengthen financial Mr. DIY stability and facilitate sustainable growth.
Assalamualaikum everyone, my name is Nur Ain Fatihah binti Zainuddin and my matric number is 288697. Okay, let's move to the fourth ratio from the solvency ratio, which is the time interest ratio. Okay, from the formula EBIT divided by interest, for the year 2022 we get 4.557 times, and for the year 2023 we get 5.209 times. DIY company's time interest earn ratio, which is TIE, increased from 4.557 times in the year 22 to 5.209 times in the year 23. DIY company ratio increased times between 2022 and 2023, which is a favorable indicator of the company financial performance. Okay, denotes increased income, better debt control, increased stability in finance, and decreased risk. This encouraging pattern shows that the DIY company is probably operating more efficiency and is in a better overall financial situation, putting it in a stronger position to pay its interest payment. Okay, for the solution, okay, from here, DIY company's time interest earn TIE ratio increased from 4.557 times in 2022 to 5.209 in 23. While this increase initially suggests improved financial performance and a better ability to cover interest expenses, it's essential to note that the TIE ratio decreased significantly from 2022 to 2023. This decline signaled a concerning shift in the company's financial performance, indicating potentially higher financial risks and a reduced ability to meet interest obligation. Proactive management and strategic planning are crucial to mitigate these risks and restore investors' confidence. The DIY company can address underlying issues and improve its long-term financial stability by closely monitoring financial metrics and implementing effective risk management strategies. Yes, let's move to the next ratio. So let's move to the fifth ratio from the solvency ratio, which is cash coverage ratio. Okay, from the formula EBIT plus depreciation divided by interest, we get 8.760 times for the year 2022 and 9.519 times for the year 2023. Okay, the cash coverage ratio of the DIY company grew in 2023, rising from 8.760 times in 2022 to 9.519. The company So DIY company cash coverage ratio improved from 2022 to 2023, which is indicative of its sound financial standing and shown ability to properly handle debt commitments. Okay, it lowers creditors' financial risk while laying the groundwork for investors' future growth and value creation. Okay. The DIY company cash coverage ratio increased from 2022 to 2023. This improvement reflects positively on DIY companies' financial health, highlighting its ability to manage debt obligation effectively. The higher cash coverage ratio provides a solid foundation for continued growth and value creation for investors, while simultaneously reducing financial risk for creditors. By maintaining strong cash coverage, the DIY company can enhance its financial stability and support a sustainable business expansion. Now let's go through the ratio turnover. The first ratio is inventory turnover. Okay. From the formula cost, which is cost of goods sold divided by inventory, we get 1.35 times for 2022 and 7.73 for 2023. The DIY company's inventory turnover increased from year 2022 to 2023. The substantial increase in DIY companies' inventory turnover reflect a significant improvement in the company's efficiency in managing and selling its inventory. This improvement suggests better sales performance, effective inventory management, and possibly increased product demand. Okay, overall, this indicates a positive trend in operational efficiency and financial performance for DIY company. Okay, the ratio is good enough for the companies, so the remarkable increase in DIY companies inventory turnover from 2022 to 2023 signifies a substantial enhancement in companies' inventory management and sales efficiency. Next, the second ratio is days sales in inventory. Okay, from the formula 365 days divided by inventory turnover, we get 270.37 days for 2022 and 47.22 for 2023. DIY day sales in receivable decreased from year 2022 to years 2023, indicating a significant improvement in the company's receivables management. Okay, this suggests that the business is getting past due payments from client much more quickly, which might improve cash flow and liquidity. When paired with the previously discussed increase in the time interest earn ratio and receivable turnover, it indicates that DIY companies' total performance has improved dramatically, demonstrating improved operational efficiency and financial health. Okay, the decrease in the DIY company's inventory days sales in inventory from 270.37 in 22 and 47.77 in 23 reflect remarkable enhancement in inventory management efficiency. This improvement indicates the company's ability to convert inventory into sales at a much faster rate, signaling improved sales performance, more effective inventory management, and streamlined operational process. Okay, that's all for me. I will pass to the next presenter. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Ismaizzah binti Wan Ahmad Rizwan. My metric number is 289700. I will to continue to the next ratio, which is receivable turnover. Formula for receivable turnover is sale divided by account receivable. So, we can see that DIY companies' receivable turnover increased from 2.62 times in the years 2022 to 4.51 times in the years 2023. The increase in DIY companies' receivable turnover reflects a significant improvement in the company's efficiency in managing and selling its inventory. This enhancement suggests better collection practices, improved credit management, and possibly increased sale volume or quicker invoice processing. For the last, total asset turnover. Formula for this ratio is sale divided total asset. So here we can see that DIY companies' total asset turnover decreased from 0.67 times in the years 2022 to 0.08 times in the years 2023. This decline suggests potential issue with sale performance, asset management, operational efficiency. DIY company should conduct analysis to identify the root cause of the decrease and implement strategies to improve asset utilization and sale generation. By addressing these challenges, DIY company can restore its financial health and operational effectiveness, ensuring long-term sustainability and growth. So, that's all for us. Thank you. For the last, total asset turnover. Formula for this ratio is sale divided total asset. So here we can see that DIY companies' total asset turnover decreased from 0.67 times in the years 2022 to 0.08 times in the years 2023. This decline suggests potential issue with sale performance, asset management, operational efficiency. DIY company should conduct analysis to identify the root cause of the decrease and implement strategies to improve asset utilization and sale generation. By addressing these challenges, DIY company can restore its financial health and operational effectiveness, ensuring long-term sustainability and growth. So, that's all for us. Thank you.